Resurgent India Knowledge Series presents live webinar on Partial Credit Enhancement, a new paradigm for infrastructure finance. Moderator Mr. Ashish Agrawal, Director, Resurgent India Limited. Eminent speakers: Mr. Virendra Pankaj, Chief Executive Officer, Aseem Infrastructure Finance Limited. Mr. Matthews Marcos, Chief Executive Officer, Muthoot Capital Services Limited. Mr. Vishal Mehta, Associate Director, Investment, Guarantco. Mr. Salim Suleiman Yahu, Chief Financial Officer, KPI Green Energy Limited.
Good evening, friends. I would like to welcome to all of you in this today's webinar on a very important topic in the infra sector financing, is partial credit guarantee enhancement, an impact on the infra financing in the future of the partial credit guarantee scheme. I would like to welcome to all the esteemed panel speakers. Those who have accepted our request and they have confirmed to speak on such an important topic, and all are practitioners in their areas, and they are having very relevant connection with the infra financing in some way, either on the investment side or on the client side, customer side. So we have a very good combination of all the panel speakers, and they will speak about the topic. And I would like to welcome to all the people who are joining us or who have joined us in this webinar from the different background. So the good part is that the people who have confirmed as participants, those are from the industry, from the banking, rating agency, from the corporates, professional technocrats. So it's a good mix of the people where we are discussing this new topic from the RBI point of view, because the new guidelines have come. So I hope that once this session will get over, you will know many new things. You will have the practical examples or practical case studies also will be in front of you. I would like to request to all of you to please ask as many as possible the questions so that we can make it more interactive and more knowledgeable, because this is a new subject for all of us. So whatever the deliberation we'll have, we'll make the white paper of it. We'll try to send to all of you, and we will try to send it to the regulator also, to ministry also, to the concerned stakeholders, so that it should be widely circulated and the people should be aware, and your suggestions and your thoughts should reach to each and every nook and corner actually. So that's the objective of this webinar. As Resurgent India, you know that we are a civilization merchant bank, and we are running this knowledge series in the last almost 5.5 years. And more than 5 lakh people have joined these knowledge sessions, and more than 2,000 speakers, the panel speakers have come from the different background also. So it has become a very good knowledge tool for the people to discuss, understand, to interact on the various new topics. So now I would like to start a small PPT which can give you some understanding that what are the clauses, or what are the areas which the RBI has covered, and what is the difference between the existing policy or the guidelines on the partial credit enhancement, which were issued almost 10 years before, and what is the new what are the new guidelines which the RBI has issued in the current scenario. So if you see, infra is one of the core strength for any economy or any country. Without infra development and infra financing, it is very difficult to run the country in a smooth manner or bring the investment from the country itself or from the outside the country also. So this infra financing is a very big large opportunity. I would like to just run through this PPT. So I'll request to my team, please go on the other slide. Yeah, please change the slide. So friends, if you see, India is having almost $4 trillion GDP currently, and we have vision to reach 30 trillion dollar economy by 2047. So it's a big thing jump in the numbers which we are seeing. And for meeting out this number, we need the huge infra financing or infra development. Without that, it is very, very difficult to achieve that number actually. Yeah, next slide. If we see the government is spending on the infra side, so numbers have almost doubled from 1.7 to 3.1 of GDP, and GDP is also increasing in last 5 years. So government is also concerned, and they are giving lot of thrust on that. And if we see the targets, it's 100 trillion rupees INR is the target for next 5 years. I think that this is a less target. The number should be bigger than that actually, keeping in mind the growth and the government plans which are rolling out on day by day. Yeah, next slide. So infra financing has their own pros and cons, and many financial institutions, banks have faced the situations earlier also. This requires a lot of long-term funding actually. And if we see the Indian banking system, they are not having the long-term deposits, so there is always a asset liability mismatch. So the structure like partial guarantee scheme and all will definitely help to better or smoothen the infra financing to the all stakeholders. Interest rate, again, the floating rate system is there, which may impact the overall viability of the project after some time. Legacy issues, we have seen the NPAs earlier in the various sectors, power, roads, and all. So these things also to be minimized. And the concentration risk, actually, if you have seen the many large corporates, those are enjoying I think this is a very important point which we need to see. Those are the large corporates, those are enjoying the higher rating. And so they are concentrating more of the infra assets under their umbrella. So this partial credit guarantee scheme can definitely help or can provide the funding to the developers which are not such large, but they are having skin in the game, and they want to grow further and they want to build the more projects and get them executed as fast as possible. Yeah, next slide. So if we see currently 84% of the allocation in the government securities, because the partial credit guarantee, we are saying that banks, other than banks, this insurance company, private, this PF funds will come as the partner. So still the 84% is from the government side in the government securities. And if we see, they are having the 61% bonds, which are more than 10 years. So that's a good thing that they are keeping long-term assets. And they have only 9.7% of the total exposure in the government, the industry bonds or the corporate bonds actually. While as per regulatory norm, it is 15%. So still the cushion is there, which they can use for the partial credit guarantee also. Yeah, next slide. So friends, if we see this RBI circular, which has come very recently, the month of August, on 6th August, where they have tried to ease out some of the areas, the partial credit guarantee in comparison to the earlier norms actually. So one of the most important thing is that they have allowed to the various stakeholders the umbrella of the partial credit guarantee issuer. So like banks, AFI, AIFI, this All India Financial Institutions, NBFCs. So NBFC and HFCs have been included first time. This is a good thing. We have Vrinder Pankaj who runs an NBFC, so definitely they can also issue the guarantee now. And this percentage of the overall bond issuance, the guarantee can be of the 50% amount actually. So this is a good thing. Earlier it was 20%, now it is 50% actually. And the advantage of this partial guarantee can be in the rating enhancement. So if suppose if somebody is having the rating in the category of maybe A rating, and as per the regulatory requirement in the country as of today, the PF funds or the insurance company can invest only on those bonds which are having double A rating. So with this partial credit guarantee, they can get the advantage of it, and they can be the double A rated category after having the partial credit guarantee announcement, and they can be eligible for the bonds from investment from these institutions. So this is really a very big benefit if this is possible. Then if we see the investor base, definitely, if you are in the higher rated bracket, then a lot of new investors will attract towards investments in your this thing bonds. And the borrowing cost, definitely when anybody will get the higher rating, like the lending is always, or the investment is always linked to the rating criteria, or the whatever the rating symbol we have. You are in which family actually of the rating, A, double A, or triple A. So this will also help you to reduce the borrowing cost, and which help in turn will help to get the more viability of your projects, or you can get some cash flow in your hand which you can use for the other projects. Yeah, next slide. So this I have already told that earlier what the banks were allowed. Now the other participants are allowed. Only NBFC, the HFC and NBFC are allowed. Only those HFC and NBFC which are in the middle layer. So any NBFC, HFC has uh, more than 1,000 crore or asset size, then they can participate in the PCE framework. Then the capital requirement, that this is another thing. I think this is a very important thing, because when the government came out with the policy earlier, that time they have to keep the this capital requirement of the entire exposure of the guarantee, or the entire exposure of the bond issuance rather than the guarantee. And now they have reduced to the PCE amount. So just for example, suppose we have issued a bond of 100 rupees, and the guarantee amount is 50 on the 50%. Earlier, it was required that the issuer has to keep the capital allocation of 100% rather than the on the guarantee amount. Issuer means the guarantee issuer actually. So this is can be a big relief on the capital side. So there can be more participants who can be interested to come forward and to issue the guarantee to the lower rated bonds actually. And one thing is very clear, that this guarantee cannot be used for the loan in the RBI circular point of view. This can be only for the bond issuance. So this should be kept in mind very clearly, because many times people are carried away that I'll take the guarantee and I will get the loan cheaper by way of this. But this is not applicable there. And one more thing is there, actually, they have now allowed the municipal corporation and even NBFC, HFC bonds also. So for NBFC and HFC, they can work on both the sides. They can issue the guarantee, or they can take the guarantee also. So this is a good part. I think this market will help with this. The NBFC, HFC will get. Yeah, next slide, please. Lokesh. Yeah, so this earlier by 20%, now it is 15%, 50% actually. And this is the second point is very, very important actually, from the guarantee issuer point of view. That in case you have issued the guarantee and it is having any uh, uh, difficulty, then it should be classified or as a default or as a NPA. even if it is of 30 days actually. So this is something which we need to discuss with our panel speakers, that how they think this clause will impact the overall requirement of the guarantee in the system, and how they will look at it also. And if you see, this is another point which is also important, that any RE, so any regulated entity of under RBI umbrella cannot invest in the corporate bond which have been backed by the guarantee, partial credit guarantee actually. So this is, I think, which we need to discuss and understand what will be the impact of it actually. Because in that case, there will be a restriction to the limited number of the investors in the bonds which are backed by the guarantee scheme. Yeah, next slide. So I think this trustee requirement, escrow management, all these things are required, and the tier one capital ka 20% se zyada you cannot do it actually. So all these are the part and parcel of the circular, and which we need to keep in mind when we are trying to take the guarantee, or we are trying to issue the guarantee. Yeah, next slide. So there are many such other instruments also, which are basically there in the market for the credit enhancement, which we will discuss in detail. The next slide. So again, this will help the unlocking the patient capital, which is the provident funds or the national pension fund or the life insurance. So this is a very bigger market where they can start investing in such bonds, and definitely the infra financing will get the boost, and overall the sewers and the corporates will get the advantage of. Yeah, so this is something which I would like to just thank you very much. I would like to just present from the regulator point of view. Now, I would like to welcome again to all the panel speakers, and we have very good panel speaker, veteran from the industry, practitioner. So we have Brinder Pankaj, who is the CEO of a very well-known NBFC, Infra NBFC, is Asim Infrastructure Finance. Pankaj, you are a veteran. I've listened you earlier also in many forums and all, and we are very straightforward on your discussions and all. So I would like to welcome you in this session. And so, Pankaj, we would like to understand from you the infra financing landscape in India. What will be the impact or the advantage of this guarantee scheme, and what are your views on this entire scheme from the um, NBFC point of view? Whether you will be the giver, you will be the taker, and what is your advice to the industry also? So over to you, sir.
Thank you, Ashish. Thank you for having me here. So as you said, I have a tendency to actually sometimes oversimplify, but the advantage of oversimplification is it makes the concepts very clear. So let's take some step back and just see where we are as a country. See, I believe and very clearly and unambiguously that this currently where India is the golden opportunity for our generation and maybe next generation to make sure that we cross this hump and painful cross of being a developing nation for last I don't know how many decades. At least I have been calling since my birth ourselves as part of a developing country. So there are so many countries in the world which have made this transition in 20 years time. If we miss this, I think probably future generations will not forgive us because we are at the perfect stage in every aspect, demographic dividend, demand, you name it. I mean, we are in a, and how the rest of the world is where it is. So we are in the best position. Now, if we have to become a developed nation, the path to developed nation can and does go only through infrastructure, because it has a GDP multiplier of 2.5 to 3. So 1 rupee in infrastructure is as good as 3 rupees added to the economy in multiple ways, right? So infrastructure is the way. Now, if we have to get there, the current investment we have, the current sources and uses and investment and projects is not enough. What we have done is great. I'm not at all playing it down, but what we need to do in next 20 years is many times more than what we have done so far. Now, to do that, we need every possible source of capital. India does not lack entrepreneurship. We have, I mean, our entrepreneurs have, I think they have come through despite hundreds of restrictions and challenges and problems which they have had to face. So, entrepreneurship is not in short supply. Skills are not in short supply in our country. Capital is in short supply, which means we need to bring every source of capital, domestic, foreign, Indian, retail, insurance, provident fund, banks, NBFCs, every possible source towards infrastructure. Now, and anything and everything we need to do to facilitate it, make it easier, possible, we need to do it. Now, that is the bigger picture. Now, infrastructure is a sector which is very long term. So, obviously, it has certain risks and certain rewards, which, probably everyone in the on the investor side may or may not understand and appreciate to equal extent. So, logically, the risk should sit with people who understand that risk best. But investment should not be limited to only those people who understand risk best, because there are very few. India has only 9 infrastructure finance companies, only 9. And out of those 9, Asim is the only one which operates in private sector. Or rest all 8 operate in government sector, or, managed by government of India. So it's very, very narrow. That's not enough. So we need to bring everybody onto the table, and that is where something like partial credit enhancement or credit enhancement in general, because what it does is it allows other participants who may not be infra experts today to come and invest. So, which is why credit enhancement is important, and credit enhancement, there are many ways to do credit enhancement. Partial credit enhancement is one of them, and RBI has come out with guidelines which are, I would say, progress from what it was, but obviously there is a lot more, and maybe you will hear that from my colleagues also here as to what all we need to do going forward. But there are other ways to do credit enhancement also. Internal credit enhancement, for example. So I remember my team had once done, and that time it was first time in India. 17 SPVs were put together, and we pooled their cash and enhanced the rating of the pool by 2 notches, and that led to that paper which was underwritten by us, then being distributed into the market. It happened about 7 8 years back. After that, today cash pooling is a standard feature in India. There are so many transactions which have happened after that deal, but till that time nobody had done it. So, to that extent, I think the transaction which has happened now and which we are going to be discussing is a very good step, because I believe this should lead to many more transactions going forward in future, and through all possible means of credit enhancement, so that we can bring more people. Our regulators have restricted that pension money and insurance money cannot be deployed anywhere which is less than, I think, double A or maybe double A plus as well. So now, if it cannot be deployed, the only way we can bring capital to infrastructure is by taking the rating to double A. So, कुएं को प्यासे के पास ले जाना, that is also okay. Anything and everything that needs to be done, we have to do. So this, from that point of view, it's very simple. It has to work, and it has to be manifold from where we are today. We have to do it 100 times more. So yeah.
Great.
So,
Great,
yes,
Pankaj.
Ashish.
Yeah, thank you very much. I think you have very well covered the need of this kind of I think, announcement. And there can be other ways of enhancement also. Cash flow pooling and all these can also help coming by 7, 8 entities together, and then the rating can be enhanced also. So that's a good perspective which you have given. I'll come back to you in the second round, sir. We'll discuss specifically on the PCE. Now I would like to invite Salim ji. Salim ji, first of all, I would like to welcome you. And Salim ji, you are the part of a very large group in the climate uh, funding, or climate, not climate funding, climate practice actually, where you are helping the climate by way of your practices. So this is a very large sector, and you have seen also that government has solar, wind, hydrogen, battery storage. So newer things are coming, this pumped storage and all. So it's not necessary that any developer who will come in the market and will get the double A rating on day one and will get the funding at the cheaper cost long term. And also, India is having the market which is where we have more than 6 crore SMEs, and everybody want to become big. And out of that, many are in the infra sector also. So there are many first timer also, which those were the EPC companies are they are going into the project development also. And in last 5, 6 years, it has happened in many places actually. So being you have already done some transaction in the this guarantee scheme. So we would like to understand your practical experience and your message to the your co-brothers. Basically, those are into the business in the same kind of business, but they are not as big as you are. How they can take the advantage of it, and what are the areas where they should keep focusing, so that they can be eligible also and they can be successful also. So what are the do and don'ts for this actually, which you can suggest to the people who are here and they want to understand from? Over to you, sir.
Yeah. Thank you, Ashish ji. First of all, thank you for inviting us for this wonderful knowledge session. And I also welcome all my stakeholders, I would say, Virendra ji, Vishal, because we have worked together for this transaction. And it was a very good experience, I would say, that doing something for the first time, because it was India's first externally created partial enhanced credit kind of a green bond. So we had two challenges. One was that we have to do an NCD because KP group as a whole has never done an NCD. And along with that, we wanted to do as a green bond. So it was one on the ESG part of compliance was also important, and another part was the rating of the NCD also was important, because at our own rating, that we had a standalone rating also, it was still, I mean, the pricing would have, the coupon rate would have been higher. So that's where, we got a support from Garanco. Nevertheless, I mean, they did their due diligence. We had a discussion, very good discussion, and we did raise this particular. So multiple things we have learned from this. One is that, especially in case of infrastructure of green, I mean, when I say about green infrastructure, there's a long gestation period. Your projects your PPAs are 25 years, your projects life cycles are 25 to 30 years. So it's a long gestation kind of a sector or a segment, I would say. So there, first of all, the investor would be a little bit skeptical, because anybody would like to have a smaller gestation kind of a period projects where it turnarounds very fast. In such scenario, it is very important that you get support from a better rated entity, or you can somebody like Garanco, or somebody like in domestic market you have IFCLs or REC, these kind of things. What happens is that you have the execution capability, you have the ability to execute. Like, for example, the KP group has already done more than 2 to 3 gigawatt of execution, and that's what I mean. That comfort you can give to that guarantor, and with that comfort you can convince the investors also and get the required funds, because again, I mean, the funds requirement are huge when it comes to the infrastructure of what is a green or a renewable energy infrastructure. Other part which we've learned on the ESG part, because we are an renewable energy company, and we wanted to have the compliance, because there are a lot of compliance when you raise a green bond. It was a normal NCD would have been easily for us, but with the support, because we have to do align with the compliance of Garanco also. It's an international entity, they have their own ESG compliance, then with a SEBI ESG compliance. So all this have to be in line. Only you are able to do that only when you have your in-house properly, you have your books properly, you have your transparency level good, you have your what is say, SOPs for the ESG compliance and everything. So overall, if you see what we got support from Guaranco, we got a very good coupon rate because of that. I understand, we could have been somewhere at 10 to 11% or 12%, but with the support of Guaranco, we got the 8.5% coupon rate. That was something. Multi-notch upgrade from almost 4-notch upgrade, the support that we got from Guaranco. But also, I mean, it is not that it is a very long process. We had to go through it because again, what Virendra said that domestic market was not so keen about getting into these kind of arrangements. So we had to, and Guaranco has done that in multiple countries, and we appreciate that they had that comfort with us after going through their due diligence and everything. So overall experience was very good, and we were able to be the first starter in this, and we look forward that these kind of assignments other players also can do it, provided they get a very good supporter like Guaranco and a good investors like Asim Infra, because in our instrument also, Asim Infra is the biggest investor. After that, there are SBI Cap, there was Geo Finance, there was Edelweiss. In fact, the requirement or the need, or the ask of the majority of the players was, even Asim Infra wanted to take the entire, but we had a little bit portion carved out for others also. Along with that, even international player like Standard Chartered also, they wanted to get into at a full rate, but we said that okay, fine. It opens a door for first transaction. Now we'll go through other transaction, and it will help us to raise more funds for our growth, because as we know that the renewable energy segment is growing very fast, and there is a lot of growth prospects in renewable energy sector. So we want to capture that growth, and for that we would require stakeholders like Asim Infra, Guaranco, where they will support us for this growth structure. We have the execution capability. It's only the support of the investors and the association like with Guaranco. It will help us to grow further in this particular model, I think.
Thank you, sir. Thank you, Salim, sir. I think you have given very clear-cut message. 4-notch rating upgrade, you said, I think.
Yes, 4-notch rating upgrade. So our
It's unbelievable, sir.
Yeah, A category. Our standalone rating of KPI is A category. So from A category to AA plus, 4-notch rating upgrade. And yes, rating is an important factor in this entire transaction also, because finally it is the rating which drives your coupon rate, which drives a lot of other factors also. The investors' comfort, also everything. So convincing the rating agency is also a big part, where Guaranco also helped us. I, being an ex-rating guy, I was director with Crystal Rating, so I also understand that what is that the rating agencies look at, and presenting it in that way, it helped us to get that highest rating that a company like what would always dream for getting such kind of rating. Vinasi can vouch for that. Very few companies can get a AA plus kind of a rating when it in its first initial bonds also.
So many congratulations. I think you have shown the path to the other companies also, and I look forward that in the coming future there will be many such instruments which will be in the market, and many people will be there who will be the investor also. As you told that you could not take more of the investors, so that's really, I think, great message which we are giving to the entire country, that we should try these structures and try to take the long-term funding at the lower cost also. Thank you, sir. So friends, now we have Matthew Marcos ji, who is the CEO of Muthoot Capital Services. Muthoot Group is a well-known group in the industry, and they are running 3-4 NBFC different names. And Muthoot ji, Matthew ji, first of all, I'd like to welcome you, and because you are in NBFC business, so now the RBI has allowed the NBFC can also take this guarantee for the refinancing of their bonds. So that is one area which I think we like to understand from you. But we would like to understand in the broader terms that NBFC, what do you think that the guarantee scheme will be good for the NBFC sector? And would like to whether you would like to use these kind of instrument in your funding requirements.
Yeah, good evening, everyone. And Ashish, thanks for having me. I hope I am audible.
Yes, sir, you are audible. Completely audible. You are not visible. So I think you told you are traveling. So
yeah, okay. I'm traveling, so I've not switched the camera on. But no, yeah, so Yeah, so I actually just first want to point out a broader change which is happening on the funding side. So while overall bank credit growth has slowed to a multi-year low, so it's only 9.5% YOY is the growth in Q1 on bank funding, and the bank loans to larger corporates has risen by just 0.8%. Okay, but there's been a sharp surge in corporate bond issuance. So during the same period, there's an 86% jump in corporate bond issuance during Q1 of this year. Okay. And this has been a steady growth. Last year, the whole of last year, 10 lakh crores of bond issuance happened. So I think there are some clear drivers for this because the rate of fall of interest rate in the market is much faster compared to a very sluggish transmission from banks. While repo has reduced, the transmission from banks onto the rates have not happened to that extent. Again, there is a very deepening investor base in MFs, in insurance, AIFs, PMS, and HNIs are also very active. So there is enough fund available in the bond side. Then technology enabled access through online bond trading and a growing secondary market. All these are really helping. And then now, investors are willing to take a higher risk also. So I think all of these are very, very positive for the overall bond market. And that is also, and combined with a sluggish offtake in credit from the banks, especially to the NBFC sector, is also a dampener. So I think this is a very, very interesting prospect and this is going to stay. Also, I think RBI, SEBI, all of them are pushing for these kind of deals. So I think we are in a very good space, and NBFCs like us are going to hugely benefit out of this. And I must say that our association with Guarantco has really helped. So Guarantco did our first deal last year, last September, and the current one which we are doing with them is the second deal. And here we have got a 6-year bond issuance, which is really very helpful for us because on an average we were raising funds for a 24-month period at the best. So here we getting a 6-year bond. It's really helping us in terms of our repayment because our portfolio is also shifting from two-wheeler to larger ticket loans like cars and CV, which are longer tenure loans also. So with a larger tenor funding, it will help in our ALM as well. So I think this is a very, very significant move. And as Salim was mentioning, we also got a free triple upgrade in our rating. We also got a AA+ in our bond. And that also has a lot to do with the intervention of Guarantco. So I think very, very interesting times. And I think such deals are going to stay and we will see many more of these happening.
Great, sir. Thank you so much. Giving insights also and your association with Guarantco. So first time and second time both. And it's a successful transaction also. So great, sir. So now I would like to invite Vishalji. So first of all, Vishalji, welcome to you. And both of your customer, or I will say that your partner, they have given the very good feedback about the Guarantco. And our audience is also very much keen to listen from you that how you are working in this guarantee framework for the various corporates, NBFCs and all. And people would like to understand the global market because you are doing this since last many years and you have done in the other countries also. So how is it different from the globally and in India? And what are your plans for India in terms of the guarantee scheme which you are running? And because in India, this market is opening up now basically for the Indian entities also to issue the guarantee with this guarantee scheme. So we would like to understand, you give your some thoughts also, what are the risks because every institution who is issuing these guarantees and all, they are perceiving some kind of risk. So what is your experience in the last many years where you have issued guarantees and you recover that money also and whatever the end of this tenure of these instruments? So that the journey of these instruments also will help to understand. So over to you, sir.
Oh, thank you, Ashish, and thank you to fellow participants, Virender ji, Salim ji, Matthews. We have worked with them on the KPI transaction and currently working with Matthews on a live deal. So just to throw in a few lines about Guaranco, because I don't think people know. The wider audience may not be aware, while the panelists and yourselves, you may be aware. So Guaranco is we are a DFI, development finance institution. Our mandate is to enable sustainable infrastructure in low income and developing countries. Our primary solutions are local currency credit solutions, which essentially help to unlock the potential of capital markets, local capital markets, and then as a result close the infrastructure gap in these countries. Our ownership is largely sovereign, with the primary backers being the government of UK through FCDO, governments of Netherlands, Switzerland, Australia, Sweden, FMO, Canada, and AFT, which is French. We have a global rating on the international scale. We are rated A1 by Moody's and AA minus by Fitch, which is much higher than the sovereign rating of India, even after the rating upgrade. So that is a bit about us. In terms of our primary business, we are in the business of providing solutions which help develop the local markets and provide close that infrastructure funding gap through guarantee solutions. So focusing on the transactions that we've done in India, so while the transactions that we have done with KPI and with in earlier this year with Vivriti Capital were bond transactions, we actually started in the more recent past. We worked in India in the we started, I think, in India in 2000, somewhere around 2010, more than 15 years ago, with our first few transactions. But I think things have really picked up after 23, when we did our framework agreement with Axis, and we've guaranteed loan transactions. That was the one which Matthews was talking about, that we started off with loan transactions, but our ultimate objective is to help develop the local capital markets through bonds. Now, how bonds are different from loans is that bonds obviously are more geared towards longer tenor financing, are more market oriented instruments compared to loans, which are more bilateral, which is where the investors with long tenor liabilities like insurers, pension funds, mutual funds come into the loop, because banks, as you rightly said, they are running today a very tight book, and asset liability is not something which most bank treasuries like to manage these days. That's why the data that Matthew presented, that the growth to large corporates is only 0.8%, which is stark, right? In the past, you would have corporate banking teams doing large deals, project finance, big transactions. I think those transactions are not happening anymore, and bond markets are the ideal place for investors and companies like KPI, Muthoot Capital, which are companies which are well rated in their own right, running strong businesses, strong franchises with great sponsors. But at the same time, like an equity promoter, everybody is looking for the best deal. And I think bond market, through that market discovery with a higher rating, being able to get an attractive coupon, longer tenor, more volume, is helping bridge that gap. And we through our guarantee provide solutions in many forms, but I think in simple terms, we call ourselves as a credit enhancement provider. That credit enhancement works in a very simple manner, wherein, like Pankaj ji said, Virender ji said, that he simplifies things. So we also keep it very simple, just to keep it at a very high level. The guarantee is essentially something which comes in to, like in the structure that we have done with KPI and previously with Vivriti in March, is basically to come in as a backstop in case there is a shortfall in the cash flows that the company is generating to service the debt. So there are the usual credit enhancements which are already baked in the structure, like cash pooling, DESRA, and so many other things. And if all of these things fail, God forbid, they shouldn't, but in case they fail, we come in and provide that liquidity support by making good the investors on the monthly, quarterly debt payments, whatever are due under the bond. So in a nutshell, that the structure works in a very simple manner. We are not regulated by the RBI. We are an overseas entity. So while the partial credit enhancement guidelines are a step in the right direction, I think there are certain and again, these are not house views, these are my personal views, that there are certain tweaks which are needed to make it more robust, because as you would have seen in the recent some of the reports which are published by ICRA as well. I have read one of those reports. They have pointed out to certain things which need to be more clear around how this partial credit enhancement, as per the framework, RBI framework, will work in case there is a cross default scenario, in case there are other competing debts which are at the same security status, so on and so forth. So I think those things will evolve over time, but from our perspective, we look at this as the way forward. And while we are working very closely with Asim Infra, SBI Cap, Geo Credit, and several other investors on live transactions as we speak, the plan is to have real long tenor capital which is lying today with insurance companies to come into this sector to boost growth. And that infra, from our perspective, given our green credentials, needs to be towards more sustainable infrastructure, including green energy, green transportation, recycling, circular economy. Those are the sectors that we are looking at very actively. And also financial inclusion, which a company like Muthoot enables, given the market segments that they operate in, and in turn, they're helping their customers to choose more sustainable options. In terms of what we do differently outside India and versus what we do in India, not too different. I think India is a very well developed financial market. The regulators in India are best in class. Both the Reserve Bank of India, SEBI, and even the insurance regulator, I think they are best in class regulators. So there are already good regulations available. It is now up to the investor community and the ecosystem to really uh, take notice of such options that are available in the market, both as a liquidity provider, as a partial credit enhancement or a credit enhancement provider, and as an issuer, to actually take that leap of faith like Salim ji did. When we started the conversation, Salim ji actually took a leap of faith that, no, I will do this. The sponsor, Farooq ji, also took that leap of faith that, no, we should get this done because we want to be not just do it for ourselves, but do it for the ecosystem. So I think that change in mindset would really help. And I think from our perspective, there are obviously challenges, like Salim ji said. I think the rating agencies took longer than we expected. That was something which I think honestly the rating agencies also need to step up and fine tune their frameworks and their methodologies to bring this to fruition in the real world. Apart from that, there is also, I think, a need for Indian corporates, Indian issuers uh, to anticipate that these sort of green bonds come with higher compliances or stricter compliances on the ESG front, which they may or may not be geared to at this stage. But I think it's always good to have like an ESG team already working on some of the initiatives and being up to terms with international standards, because those international standards really are best in class. And I think for India, while infrastructure contributes and is reflective of our growth as a country, I think it also adds to the happiness quotient of a country. Good infrastructure defines the happiness quotient of a country, in my view, in more ways than one. Because I was just seeing some pictures from the metro which was inaugurated, the Cuff Parade one, and I could see the smile on the faces of those passengers who mostly were South Mumbaikars, who generally would not use public transport. But because this infrastructure is world class, it actually brought a smile to my face as well, that seeing so many of these socialites use public infra, which is and it was great. So I think it will help the country, it will help the cities, it will help declog some of the bottlenecks that we have. And I think overall it's a step in the right direction. Guaranco on its own, we are also planning an event in towards the end of November, a market event where we are inviting all the stakeholders to participate in discussions where we'll present our perspective and our thoughts on how this can be scaled further. I'll take a pause. Thank you.
Great, sir. Thank you so much, Vishalji. I think it is very much informative from the international perspective also, and domestic market also. And your views on the RBI policy also, you have given some thoughts on that also. So this will be helpful, and the I think event which you are organizing, please let us know. We will send it to our participants also. So they can, if they want to attend, they can attend also. So that's great. So now I'll come back to Virender ji. A specific question on the partial credit guarantee is key because this program which we have organized, keeping in mind that program. So, sir, if you see this, RBI has put a clause in the circular that REs cannot participate in the bond issuances which are backed by the partial credit guarantee. So it means that the banks and the other NBFCs are out of the investment. So what do you think? Because you are also one of the NBFC, infra NBFC. So do you think that there should be some change in that, or this is the right strategy? Because ultimately the higher rated asset will not be with them now, basically, in that case, after this partial guarantee. So your views on that, sir, that is one point. And another point is this 30 days repaid requirement drawn actually. So this clause is there where they have said that the RBI require that any drawn PC be repaid within 30 days. So that's another point. And third point, which is there actually, this 50%. So why anybody will go to the domestic RE? They will go to Guaranteco. Guaranteco can go to 70%, 80%. Then what is the the advantage of taking the domestic RE? So can cover up those two, three areas. And I will ask the other panel speakers also to, I think, comment on that also from their experience point of view, or their understanding point of view. Yes, sir.
Sure. See, at one level, it's very simple to understand that why RBI restricted, because they thought probably that the idea is to deepen the bond market. They want insurance companies, provident fund, and others to come in. So let's keep the regulated entities out because they already have appraisal skills, right? They don't need this kind of a protection. They can do even triple B loans. So that could have been probably the reason. But the challenge with that, that approach, if you ask me, is, let's take example of NBFCs. India has 9,300 NBFCs. Can we believe that appraisal capabilities of all 9,300 NBFCs with respect to risk assessment and understanding of a infrastructure project and a relatively long rated product are equal? Can we believe that all the banks in the country, small, medium, large, private, public, foreign, have equal ability of risk assessment? If they had, we would not have trouble, right? 20, 15 years back or 10 years back in banking system, right? So it's very obvious that they don't. There will be some people who will be the leaders, thought leader in terms of understanding, and others will be the follower. So, in my personal and humble opinion, everybody should be allowed to invest because all are not equal, all don't have equal abilities. But what can happen? See, if I am a investor, first day I will invest because Guaranteco is underwritten, or tomorrow NAPFID will do, or SBI will do, or somebody will do. But second and third time, over a period of time, I will build my own risk assessment ability, and I will go directly to KPI Green or customers and say, don't worry, I understand this business now. I'm very comfortable. I can do transaction even if it is lower rated. See, nothing stops us from doing bonds which are rated A, right? It's just because the market has been so used to, and provident fund and insurance companies have a restriction. Nothing stops me and you from putting money in a rated bond. So we will do it, right? So everything has a time to, expect on day one, that, this is how it will happen. Insurance industry will jump in and pension. No, it will not happen. And banks and many other regulated entities even assume, after some time we may allow, or we may share our this bond with other people so that more people understand. That's how you build a market for anything new. So regulated entities can play a very good warehousing role. So if we think that this is going to discourage, I don't think so. But even if, let's assume there is a reason, they can always say that REs can come up to X percentage of issue, ADA, 50%. And then after 1 year, you have data, you judge the data, and let data be the guide. If only REs are doing, nobody else is coming, then you can tweak the timeline. Otherwise, we should continue. So nothing stops regulator from tweaking, fine-tuning their guidelines, basis data. So I think it's too soon to have these kind of restrictions in my personal view. And I would say the same on this 30-day timeline also, because see, and it's a larger issue, honestly. It is not just limited to partial credit enhancement or bond market. It's a longer issue with infrastructure. See, we need to understand that there is a fundamental difference between a liquidity risk and a credit risk. Infrastructure projects run for 25 years, 30 years. Your transmission projects have a scope for renewal, so they can be 35 years. Our airports can run for 60 years. The concession is extendable, it can go up to 60 years. So when you are talking about 25 to 50 year of assets, a temporary liquidity mismatch, which can happen due to so many reasons, right? I mean, we all of us saw COVID just few years back. We should not forget there can be temporary liquidity challenges, but it doesn't mean that the fundamental of a airport have changed for India, or any road or any transmission or any asset has changed in because of COVID. No. So temporary cash flow gaps has to be looked at differently from a credit deterioration. And people, there are people with those abilities to understand those risks, and even RBI has those ability to understand whether this is a case of a liquidity mismatch or this is a case of a credit deterioration. So if it is credit deterioration, by all means consider it NPA and whatever in due course of time. But if it is only liquidity, then you can't equate the same. They're not the same in a 25-year project. It is okay if it is a 12-month loan, right? There I can understand 90-day rule, 30-day rule, all those make sense. Oh, 25 saal hai. Matlab, where is the asset going? Asset is for country. Let's not forget. It's not for me, our developer, or anybody. Some of these assets are BOT. They get transferred back to people of India after they run their concession period. That's what happens in roads. So we have to look at infrastructure differently, honestly. So, and same way, this 50%, okay, it's helpful. I'm not saying it's not helpful. But again, see, this is ultimately a risk too. As I said, there are so many ways to reduce risk. Even customer, rating agency, guarantor, all of them will do their best to reduce the need for guarantee, because it has a cost after all, right? It's not free, credit enhancement. So leave it to them. I mean, why should we get into कि 50 होना चाहिए, 20 होना चाहिए, 10 भी हो सकता है कहीं कहीं पे. And suppose it's a new sector, it's a challenging sector, it's a social need, sometimes it happens. Let's say weak municipal corporation. Now India needs municipal bonds, and this is a beautiful tool for municipal bonds to bring them to the market and also teach them the market discipline. See, once you start issuing, accessing capital market, your discipline has to be far more than what it is there in Indian loan market, right? So municipal corporations will also learn. So if it needs more, let it be more. So and again I feel after maybe enough data, after 20, 30, 40 issues have happened, then maybe we can sit and discuss these things with regulators and say that okay, whether we should have a cap, whether we should prevent regulated agencies or not, how should we tweak. The SEBI has done no less than 20 amendments to InvIT guidelines after introducing them first, and today they are working beautifully. So fine tuning is always welcome. You can do it, but my view is let's do it after some data. To do it from the beginning, I feel somewhere will limit. In short run, not much, because 50% is pretty good. It's strong enough, but it's more about principle. In my view, why should a regulator get into this? It's between the
Great, sir.
issuer and the guarantor.
Pankaj ji, great. I think you have given your straight answer, which I was expecting from you. Thank you so much. Salim ji, so I think many people would like to listen from the horse's mouth actually. When you compare external and domestic PCE models, and where do you see the biggest difference in the for the issuers? So in terms of due diligence, intensity, pricing, and the investors' attractions and all. So, but you have done that transaction, and you have told that there was a 4-notch rating upgrade also. So there may be such many other examples which must have helped you in this transaction. So I think if you can throw some light on that, that will be helpful.
Yeah, Ashish, so I mean, if you look at the external versus the domestic, what we call the partial credit enhancement or the model, the difference we experience not in the due diligence or the other part is always there. Due diligence is always there in both, but in availability of the investors, availability of investors. That see investors, also from the partial credit guarantee, if we have somebody like IFCL, domestic institutions, REC or MNRE giving kind of a guarantee or an AFID or any of the Indian institutions giving a guarantee. So they need to take again what Vishal also said, a leap of faith. What Garanco took. I mean, I would say, I mean, we appreciate that, being an outside entity, they took a leap of faith with the country. Nevertheless, I mean, what Virendra also said that, guarantee is not the prime, what we call a prime, support or something. It's a collateral support. Initially the company has to be very strong. It has to have a good strong cash flows. It has to have a good ring fenced for those cash flows, good escrow mechanism, if any additional liquidity, all these factors. Garanco comes as an additional support, and that support should be utilized for creating impact with the comfort with the investor, creating an impact on the coupon rates, all those factors. But first thing is that, yes, and I also agree what Ashish ji said that the guidelines, I will just like to shift to that particular portion of the guidelines of 30 days, NPA kind of criteria and everything. See, all businesses have ups and downs, and especially our business, renewable energy, is totally dependent upon the seasonality. You won't find good generation during the what we say the monsoon region. After monsoon, there will be a good generation. Wind will play good during winter, and so there will always be a seasonality. So putting a tag of 30 days or something, yes, the credit worthiness of the company has got good strong assets. It has a strong PPAs, long-term PPAs with a very good counterparties. That is where important factor needs to be set. This small criteria of liquidity will keep on. As I also agree that liquidity will keep on off and on, will have some impact on those things. But that has to be something which has to be that yes, over a period of time, once we get more used to these kind of instrument, after that, when we evolve, we can set up these kind of parameters. But initial phase is it. Moving back to our domestic versus when we launch this particular, we discussed with with Garanco on this. So we had a lot of factors. I mean, we had to convince Garanco also a lot, because even they are taking on a third party which is new to them altogether. And it was, I mean, they are coming from overseas and they are taking a call over here. They need to understand, because even, I mean, their credibility is on stake when they take a guarantee on somebody like us. So giving that comfort is more important, and that's where the Indian domestic, or you can say, institutions which could have given guarantee like IFCL or something, they should also take a leap of faith and understand that the businesses are there which can flourish with their support. It's only they have to lend their hand. It's not that they are taking the risk, a total risk on them. They have to do the due diligence, like we did the due diligence with Stancy, Asim Infra. They also did the due diligence part of them. But the additional comfort that Garanco gave them, that moved the entire thing faster. Otherwise, I mean, it will take time further to get into diligence. But that additional comfort is what Garanco provided us, and we are thankful for that. That led us to a stage. And I agree that once we have this first transaction, I know even Garanco would not like to to do us the baby step with a walker, but they don't want us to be with a walker for the rest of their life. Next time they would say that fine, you are now in the market. People know you very well. Now you can raise it on your own. And at that time, I think investors like Asim Infra will also be appreciating that. Okay, fine. We have done one transaction with them. We are comfortable. Now we can go ahead with this. So the idea of doing this entire transaction was that starting a kind of a phenomena where everybody will start, do a first kind of transaction, then move on, and then that's what is then developing the bond market over a period of time. That was.
Thank you so much, sir. I think you have some track record, then definitely it will help you to bring the domestic investors also to come in the picture and take the investment bet also. Great, sir. Thank you so much. Matthew, sir, Matthew ji, for NBFC, money is raw material. Actually, they need money for the future, for the lending, not for the refinancing, actually. So, as per RBI, these new guidelines, they have restricted that NBFC or HFC can they take the partial guarantee only for the refinancing purpose. practically in last 20 years, I am practicing with the NBFC. I have not seen any NBFC has taken the refinancing. Rather, they have taken on the money for the onward lending actually. So if you have issued the bond and you want to refinance, and I think this kind of scenario is very less. So what do you think from your point of view, whether this guideline will help you or there should be some change on that?
See, I may not want to comment on a policy decision. While it could be slightly restrictive, I think that is not the only source of fund. I think this is opening up a new, completely whole new avenue for the NBFCs to catch upon, and therefore this can be an additional source of funding while the traditional sources of funding continues to remain robust. So I don't see there is see that as drying out and this being a only replacement. So to that extent, I think it is not a complete detriment. However, if it opens up for or all the things, then I think it will be an added advantage. That's what I feel.
Do you think that it would be a little better if they will allow for the loans, also partial credit guarantee for loans from the Indian ecosystem? I think definitely it will be helpful.
Yeah, it will definitely help. Yeah, it will definitely help.
There are many such NBFC which are rated A or triple B. They can get that advantage.
Absolutely, absolutely. So I think if they open it up, it will be a really game changer, I think.
Okay, thank you. So Vishalji, we see the guarantee, we are talking about guarantee, partial guarantee or guarantee. So ultimately, at the end of the day, people just see on the monetary terms. What is the cost of it actually? Because ultimately, if you are getting money at X and you have the guarantee of money getting money at X minus Y, then it makes sense because ultimately it's a money. So we would like to understand when such kind of structures are there. So will there be any advantage to the borrower in terms of pricing, or what kind of cost you generally charge on the guarantee when you are issuing guarantee? So there are some structure, some metrics or something which you work, or there is a straight flat fee which you charge.
Oh, thank you. So I'll again keep it generic, uh, because uh, because see, RBI has for an international overseas guarantor, which is a DFI like ourselves, there is a guideline or there is a cap for charging 2% of the guarantee fee as per the regs for the bonds, uh, and I think we have followed those guidelines. But yes, each transaction is different. The underlying risks are different. The underlying mitigants are different. So every transaction is priced differently. But when you say about uh, what advantage, I think it goes more than the cost. So somebody who's doing it for the first time may not get those benefits in the first transaction, but then going forward, if that issuer wants to do a similar structure with somebody who's comfortable now with the credit as an investor, then that would actually translate into benefits for that next transaction. That is, I think, uh, my way of looking at it, and it has to be looked at in the long run and not as a one-off, because a company which is in the renewable space like KPI is, and they have got such a strong pipeline, they will keep requiring capital, for long-term capital, for executing those projects, and this capital is required in one go. So they need to have a financial close for the entire project. It can't be piecemeal. So I think that's where these sort of structures help with also bringing in new investors who may or may not work with them on a standalone basis to begin with, and that is also our goal. Like Salim ji said, we don't want to be doing the first transaction, second transaction, third transaction, fourth transaction, because somewhere this is a tool for developing the market, and market development also entails that people don't need a guarantee. At some point in time, they have understood those risks, and as Parinder ji rightly said, not everybody is a risk practitioner. But I think if somebody who's done a good DD and who's a specialist, he's done the first time, I think it sets a good precedent and provides a template for others to follow. And given that so much information on bonds is already public, I think people can leverage on those principles, not just from a credit standpoint or a legal standpoint, but also from a structuring standpoint, including the rating agencies. Because I'm sure today the rating per percentage requirements, like the guarantee cover requirements for the first transaction, the first two transactions was more than 60%. Maybe going forward, rating agencies will also learn from their experience, refine their model to bring that requirement down and provide the same up notch, which is 3 or 4. As in the case of the Vivriti transaction, it was 3 notches. In Salim Ji's case, it was 4 notches. So I think overall this should not be looked at as a significant reduction in pricing. Although I believe and tend to agree that the issuer should be able to attract a lower coupon in terms of the bond itself with a guarantee cover or with a credit enhancement. But at the same time, it should not be looked at only from that one objective criteria. It has to be looked at qualitatively as well for benefits that accrue in the long run.
Great, sir. I think very good answer which you have given, and you have covered that maximum 2% can be the guarantee fee as per the government norms for a foreign guarantee issuer actually. So you have to work within that ambit only. And you have rightly told that it's not necessary that you'll get the major advantage at the first time, but it can create a history or track record. And when you do the series of transactions, you might get the better benefit in the longer run. So that's great, sir. I think I hope that I have covered almost all the related areas on the PCE, and I hope that all the panel speakers have justified their role. Actually, I think everybody has given very straight answers, and they have covered all the areas which are required to be discussed here. And the participants, I think they have participated in a big number actually. So, because as I told that they are participating in the different channels also. So a lot of people are there on YouTube and directly on LinkedIn and all basically, and some are there which are directly joined here actually. So we have good, I think, participation from the people who have joined here actually, and I believe that they must have get some kind of knowledge, some kind of understanding. It's a new subject. There are many terms which we have discussed. They might not have got the complete idea what we have discussed, but definitely when they will study and they will go further, they will know the better idea about these terms and all basically. So I would like to end this session here with the permission of my panel speakers. I would like to thank you to all of you, each one of you, Salim ji, Misal ji, Matthew ji, Virender ji, for taking time, because you people are so busy. You are running your organization where you have multiple transactions, multiple engagements. But despite of it, your dedication towards the industry, towards the infra financing, you have committed that you will join here and you will speak straightforward on the transaction, on the framework. It will help to the regulator also to understand what the practitioners are thinking. So as I told in the starting, we'll make a white paper. Definitely will not offend anybody. Whatever has been discussed, whatever has been black and white, we will submit the polls also we have taken from the audience also, because the wider polls always helps to make the opinion on that actually. So which we'll send you this paper before sending to any regulator and anybody that your consent is required. Then we will send it to the industry across or the ecosystem, so that there can be the consensus which can be created, and maybe not today, but after some time, these things can be changed. So I would like to thank you to all of you once again. And I'd like to invite you for more discussions on the PCE or DCC or other areas where your expert advice will help us to connect with the audience. I would like to thank you to all the participants for joining with us and encouraging us to do more such programs. And the last, I would like to thank you to the Resurgent India team. Those have worked hard actually to bring us at one place and discuss on such an important topic. And in the future, we see that there will be more transactions, more partial credit guarantee, and this will be discussed on many other forums also, so that everybody can take the advantage of it. Thank you once again to everybody. And I would like to just say good evening to everyone. Thank you so much. Thanks a lot.
Thank you. Good day.
Sir. Thank you.
Thank you, Ashish. Thank you, everyone.
Thanks a lot, sir.